Good morning, ladies and gentlemen. Before we start, please let me take a moment to flag that certain financial information contained in this document is unaudited and figures are non-IFRS. This webcast, including the Q&A session, may contain forward-looking statements. These statements reflect the company's beliefs and current expectations concerning, among other things, the company's results, operations, financial condition, growth, and strategies. Forward-looking statements are not guaranteeing future performance of the company. Please take a moment to read the disclaimer included in the presentation. You can send us your questions through the event chat during the presentation. To do so, please go to the bottom right-hand side of the screen where the chat is located and select all panelists in the field 2. We will do our best to reply to all of your questions at the end of the session. So today's conference call will be conducted by Carmen de Pablo, new CEPSA's CFO. So without further delay, Carmen, the floor is yours.
Thank you very much, Gonzalo. Good morning, ladies and gentlemen. Welcome to CEPSA's 2021 full-year results presentation. I'm Carmen de Pablo, CEPSA's new Chief Financial Officer. Before we start, let me take the opportunity to briefly introduce myself for those of you on the line that have not met before. I joined CEPSA in January, and I was previously CFO of a publicly listed company, Gestamp, an automotive supplier present in 20 countries. Prior to joining Gestamp, I worked in investment banking for over 15 years in corporate finance, primarily covering energy, utilities, and renewable sector. It is with great pleasure that I'm coming back to my origins in the energy space. I would also like to take the opportunity to thank my predecessor, Salvador Bonacasa, for all his hard work and dedication to this company for over 40 years, and to our CEO, Martin Wetzeler, and our shareholders for giving me the opportunity to join this project. It is exciting times for CEPSA. It is exciting times for me as we accelerate the journey towards energy transition. And without further delay, let me now run you through the key items of the agenda that we will be presenting to you today. Firstly, we will be taking you through CEPSA's key highlights for the year 2021. Second, review of each of the business units' performance. Third, we will provide with more detail on our group's financial performance before making some conclusion remarks. Now, starting with slide 6 in terms of financial performance. CEPSA reached 1.8 billion clean CCS EBITDA during 2021, a 53% increase when compared to 2020. CCS net income stood at 310 million, significantly higher versus the 1 million registered in the previous year. Free cash flow generation before working capital was 1.1 billion euros in 2021, representing a 9-fold increase compared to 2020. In terms of leverage, net debt to EBITDA was materially improved from 2.7 times in 2020 to 1.6 in 2021. We also ended up the year with a strong liquidity position of 3.5 billion euros, of which 700 million was held in cash. In terms of operational highlights, working interest production for the year stood at 74,000 barrels per day, above the levels achieved in 2020, mainly due to the lifting of OPEC quotas. Refineries gradually recovered their utilization rates, reaching close to pre-COVID levels in Q4, averaging 87% during the quarter and 81% for the full year. Commercial sales volume also increased in 2021 when compared to the previous year. This was in line with the overall improvement in Spanish fuel demand following easing of mobility restrictions. Lastly, optimization and efficiency measures continue to be successfully implemented throughout the year. And at the corporate level, as you know, on the 1st of January of this year, Martin Wetzeler joined as a CEO. Martin was previously at Shell, with more than 25 years of experience in the energy sector and the energy transition space. In addition, a new organizational structure was announced in early February to help accelerate the company's energy transition strategy and transformation. And last but not least, I would like to take the opportunity to announce to you the date when we will be communicating CEPSA's new strategy. So please put a note in your calendars for March 30th. We hope that you will be able to join us in this important event. Now moving on to slide 7, which provides you with a quick overview of the new organization. As discussed, in February this year, we put in place a new organizational structure designed to speed up the transformation process and to better capture the opportunities that the energy transition is expected to bring. With this in mind, the former commercial business unit has been split into two: mobility and new commerce, which will lead and transform our customers' mobility experience, and commercial and clean energies that will develop decarbonization solutions for both CEPSA and our customers. In addition to Martin and myself, several new executives with significant industry and international experience have also joined the company. As you can see in the slide, we are a diverse and experienced group of executives, with the latest additions being Carlos Barraza, formerly chairman of BP Spain, who is heading the commercial and clean energy business, and Sabas Manuzos, with a background in BP and Maersk, who joined to lead our trading business. This new organization places us in a solid footing to lead the company's transformation and energy transition journey. Now, moving on to the next slide, I would like to take the opportunity to stress our strong commitment and focus on ESG. ESG is at the core of our strategy, and this is an area I will lead, including the different initiatives that we have been pursuing during the past year. At a corporate level, we have prioritized 4 of the United Nations Sustainability Development Goals that we will work towards as a company. Number 7, affordable and clean energy. Number 8, decent work and economic growth. Number 12, responsible consumption and production. And 13, climate action. It is also important to highlight that between 15 to 25% of the remuneration of CEPSA Executive Committee members is linked to ESG KPIs and targets. Evidence of our efforts and commitment to ESG so far is the wide recognition by third parties through different ratings and awards we have been receiving. It is worth highlighting that we are ranked number 1 among the integrated oil and gas companies globally, according to Sustainalytics, and we are in the first quartile by S&P Corporate Sustainability Assessment. It is also significant to note the A- rating given by the Carbon Disclosure Project, CDP, in both climate and water categories. In addition, during 2021, CEPSA was also recognized by the Financial Times Diversity Leaders ranking as a leading energy company in Spain and received the Top Employer Award as one of the best organizations to work at for the 7th consecutive year, providing exceptional working conditions for our employees. It is also worth highlighting that CEPSA has a management framework for the reconciliation of personal and professional life based on EFR, Family Responsible Company, which reflects a culture based in flexibility and mutual commitment. In 2021, we have positioned ourselves as one of the leading companies in our sector in this area. Last but not least, CEPSA has committed to a number of standards related to transparency in its disclosure and reporting, by which all the documentation provided to stakeholders, as you can see, is prepared in accordance with the recommendations of well-recognized organizations. We encourage you to find out more on our website. Moving on to slide 9, we will review some of the strategic alliances that CEPSA has developed during the last year. In the context of the challenges that the sector is facing, and of course with the primary objective to bring our customers more efficient and greener solutions, CEPSA has reached several agreements with leading companies in a number of business segments. Just to mention some, in biofuels, we have signed a partnership with Iberia, Iberia's President Binter, which includes research and flight testing of sustainable aviation biofuels, SAF, and also covers other energy alternatives such as renewable hydrogen and electricity to promote sustainable mobility of aircraft and airport ground fleets. In e-mobility, we reached an agreement with Endesa to accelerate electric mobility in Spain and Portugal. The agreement will enable electric vehicle customers in Iberia to use both the public charging network that Endesa X is deploying and the ultra-fast charging network that the CEPSA will begin to develop in 2022. With regards to clean and renewable energies, we are going to create a partnership with Redexis, the first global network of service stations generating renewable energy in Europe. The installation of planned 40,000 high-tech photovoltaic panels, which has already started with 80 in our service stations. Lastly, in digital and technology, CEPSA is also a pioneer in Spain in the use of new Amazon Web Services technology for predictive maintenance in our industrial facilities. These examples are just some evidence of the strong focus we have on our customer partnerships. As we look to the future, there is significant opportunity to continue to work with our customers and to help them decarbonize and develop products which will support the path to net zero. Now, moving on to slide 11, we will review the evolution of the main external variables that affect our business. Brent price continued to increase, reaching an average of $7.7 per barrel during the year, up 70% when compared to 2020. CEPSA refining margin, although still within a healthy range, averaged $3.7 per barrel in 2021, the last quarter being affected by the increase in energy cost. US dollar continues to strengthen versus the euro, with an average exchange rate of 1.18. Finally, automotive fuel demand in Spain continued to recover due to the increase in activity and the easing of COVID-19 restrictions. However, it's important to highlight that demand is still below the 2019 levels. Now, let's move on to the results of each of the business units, where we will go through key aspects for Q4 and full year 21. As you can see on slide 12, all business units have delivered materially improved EBITDA performance, both during the fourth quarter of 2021 as well as during the full year. This has translated into a strong increase in EBITDA of 53% versus 2020, as mentioned earlier. At the bottom part of the slide, in the chart, you can see the quarterly EBITDA evolution, which evidences the resilience of the company and the recovery trend with EBITDA in the fourth quarter of 2021 above that of the first quarter in 2020 when COVID pandemic began. Now, we will review the performance of each of our business units during the year as well as the short-term outlook. Beginning with upstream, working interest production has increased to almost 74,000 barrels per day, in line with the lifting of OPEC quotas, and boosted by demand recovery. In terms of OPEX per barrel, the decrease in the fourth quarter and 2021 is linked to the change in production mix, as higher contribution from UAE and Algerian fields in 2021 following the gradual lifting of production quotas led to lower capex, as these are low-cost geographies. Upstream registered EBITDA of $905 million in the year, a material increase versus $458 million registered in 2020, boosted by higher crude prices and lower production cost. Finally, it is worth highlighting the long life of CEPSA's upstream portfolio, with a reserve-to-production ratio of 17 years. As per the short-term outlook, we expect Brent prices to remain around $100 per barrel, mainly as a consequence of the geopolitical tension. We also expect production to gradually increase as OPEC quotas cease to apply to our fields during this year. Now moving on to refining segment, refining margin have improved materially versus 2020, with CEPSA average margin for the year reaching $3.7 per barrel, a 42% increase versus 2.6 average registered in 2020. Utilization rates of our refineries continue to improve, with an average of 81% during 2021 and 87% in the fourth quarter, a figure already close to the pre-pandemic levels. Refining registered $93 million of EBITDA of this year, a nine-fold increase versus 2020, although still below historical levels due to the increased volatility in natural gas and electricity prices, especially during the latter part of the year, which affected our gas and power business. By a way of reference, European natural gas prices reached peak of 132 euros per megawatt hour in December versus 15 average in January 2020. In the short term, we expect volatility to remain, with utilization rates being adapted to market conditions. Now moving on to commercial. As discussed earlier, we saw positive market developments with the Spanish fuel demand increasing by 14% in the fourth quarter of 2021 when compared to the fourth quarter of 2020, which contributed to boost sales of our commercial business by 24% during this period. In annual terms, sales also increased notably by 10% versus 2020. Commercial EBITDA continued on a very positive trend, reaching $478 million during 2021, around a 20% increase versus 2020, evidencing the resilience of the business. For the short term, we expect volumes to continue to gradually recover, although at a slower pace, and margins to remain stable. Now, let's move on to our chemicals business to finish off this section. In slide 16, CEPSA's chemicals business registered another record year on the back of continued pricing and volume optimization initiatives, with sales increasing by 5% versus 2020 and EBITDA reaching $461 million, 29% above last year. A limited and intentional volume decline in lab segment, both year-on-year and quarter-on-quarter, as a result of intended margin optimization initiatives that led to a decreased sales to specific customers. It is worth highlighting that during 2021, CEPSA achieved a significant milestone by producing lab for the first time using renewable raw materials of vegetable origin. The short-term outlook is positive, with both volumes and margin expected to remain at a minimum stable. Now moving on to slide 18, we will review CEPSA key financial metrics for the year. As you can see, all the key financial indicators have shown a material improvement versus 2020. Both clean CCS EBITDA and net income have registered a robust performance, with EBITDA increasing 53% and net income recovering significantly versus the $1 million registered in 2020. Strong CapEx discipline led to a decrease in investments of 27% compared to 2020. We will go into more detail in the following slides. In terms of cash flow, CEPSA's efforts to preserve cash generation yield a very positive result, with free cash flow before working capital above $1 billion, a nine-fold increase versus last year. Net debt during the year decreased slightly, with the leverage ratio improving from 2.7 times net debt to EBITDA to 1.6 times at the end of the year. Liquidity, as of year-end, remains strong at more normalized levels of 3.5 billion euros. Moving on to this next slide, we will review the results of our optimization and efficiency program. During 2020, following the onset of COVID-19 and surrounded by an extremely challenging market environment, CEPSA launched an optimization and efficiency program aimed at protecting EBITDA and free cash flow. Throughout this period, there has been a sustained focus on improvement measures, cost efficiency initiatives, and oversight of investments. As explained in the past by Salva and Gonzalo, this program is a group-wide effort with around 700 individuals involved across all business units and functional areas, consisting of more than 1,700 initiatives aimed at boosting EBITDA and cash flow, with an organization led by our Chief Transformation Officer, Mateo, fully devoted to its delivery. Initiatives within the program are focused across 3 areas: gross margin improvement, cost reduction, or rationalization of investments. During 2021, thanks to this program, we have captured 450 million euros of EBITDA improvement. We expect this program to continue delivering positive results in 2022 and beyond. Now, on the next slide, on CapEx. In 2021, CEPSA continued to closely manage its investment portfolio by prioritizing the most suitable and profitable projects to preserve cash. As such, CapEx for the year amounted to 473 million, 27% below that of 2020. With regards to the division of maintenance versus growth CapEx, as you can see from the pie chart, in 2021, 50% of the company's investments were devoted to growth projects, evidencing the flexibility we have in terms of selecting and prioritizing higher-yielding investments. We are immersed in a far-reaching digital transformation process to boost refinery competitiveness through predictive maintenance works as well. Growth projects for the year were mainly related to the development of upstream assets, such as RKF redevelopment project in Algeria, which will allow us to continue producing crude oil from this field for around another 20 additional years, and Abu Dhabi SARB field, which has successfully adapted its development plan to achieve higher production versus the initial plan. Now, moving on to slide 21, we will review free cash flow generation and the debt and liquidity position for the year. Cash flow from operations during the year reached 1.3 billion euros, a material increase versus 2020 on the back of improved results, a supportive macro environment, and the positive outcome of the optimization and efficiency programs we undertook. This improvement was achieved in spite of an increase in working capital as a result of higher commodity price environment, higher taxes, in particular in upstream. Net investments in the year amounted to 391 million, with approximately 50% devoted to growth projects. Financing cash flow, which includes interest cost and operating lease expenses, was 227 million euros, in line with the previous year. So therefore, as a result, free cash flow before dividends reached 688 million, a notable increase versus 2020. On the back of this strong cash flow generation, the company paid 528 million in dividends to its shareholders, what is also deleveraging during the same period. As of December 2021, net debt stood at 2.8 billion euros, with leverage at 1.6 times net debt to EBITDA, a material improvement when compared to 2.7 in December of 2020. And finally, in terms of liquidity, CEPSA continues to maintain a very strong liquidity position at 3.5 billion euros, and these are, of course, more normalized levels than the 4.6 that we had in 2020, during which liquidity was significantly strengthened due to the uncertain environment due to COVID pandemic. On the next slide, we will review our debt maturity profile. From the onset on the COVID-19 pandemic in March 2020, CEPSA has worked to strengthen its liquidity position and extend debt maturities. In June 2021, we extended the maturity of our 2 billion RCF by 1 additional year to September 26, with an anonymous support from all of our relationship banks. This RCF remains fully undrawn. As a result, as of year-end 2021, the average maturity of CEPSA's debt stands at 4 years, with no significant maturities in the short term. I would also like to highlight that CEPSA has no financial covenants in any of its debt facilities, and that we hold enough liquidity to cover the next 4.5 years of maturities. Now, moving on to the next slide, we will review the key pillars of our financial policy. As you know, CEPSA has always had a focus on maintaining a conservative financial profile. And in this regard, the key elements of our company's financial strategy are clear focus on free cash flow generation, maintaining a strong balance sheet and liquidity, and an overall conservative approach with the aim to improve financial flexibility, mitigate risks, and focus on maintaining an investment-grade profile. As such, the company's financial priorities are to increase profitability, manage and select value-accretive investments, and manage working capital closely, with the overriding principle of preserving cash flow generation. And now, to wrap up, let me finalize today's presentation with some key takeaways. 2021 has been a year of solid results, and during which we have delivered a good recovery across all business units. This is underpinned by a more supportive market environment, as well as a company-led initiatives to improve performance. And as such, EBITDA registered an increase of 53%. Free cash flow before working capital for the year stood at 1.1 billion, a significant increase versus 2020, on the back of improved results and cash preservation initiatives. Leverage was improved significantly during the year, with net debt to EBITDA at 1.6 times as the year ended in 2021 versus 2.7 in 2020. And liquidity remains strong at 3.5 billion euros, covering 4.5 years of our debt maturities. The company's transformation is underway, with the ESG as the cornerstone, underpinned by recent partnerships agreements to decarbonize our business and help our customers in doing so as well. With this, we conclude today's presentation. But before we move on to the Q&A, please let me remind you again that we will be presenting our strategy update on the 30th of March, and we look forward to having you join us for this event. So please save the date in your calendars, and we will be providing further details on event logistics in due course. Thank you all very much for your attention, and I look forward to having the opportunity to meeting up in person in some near future.
Thank you very much, Carmen. So with this, we conclude today's presentation. So now we move to Q&A. Please let me remind you how you may direct us your questions. You may go to the event chat at the bottom right hand of the screen, and in the field 2, please select all panelists and then type your questions. Okay, we have a question on Russia-Ukraine situation. So what is the impact of the Russia-Ukraine situation in the business?
Thank you, Gonzalo. Well, first of all, of course, our thoughts are very much with those that are affected in this Russia-Ukraine situation. And let me take the opportunity to highlight that CEPSA is currently collaborating with various NGOs, such as ACNUR, to support impacted civilians. But in terms of our business, CEPSA has no direct exposure to Russia, and the potential impacts, in any event, are limited. We are, of course, affected by the increased energy cost and of course, of the market volatility overall. But it's true, and it's something that we can communicate, that we ceased to buy Russian crude, natural gas, and oil products on the day that the war started. And we do not see this position changing in the foreseeable future. And so whilst we have traditionally had very limited sales activity to Russia, we have also stopped selling into Russia as well.
Okay, thank you, Carmen. We have another question related to liquidity. Could you please elaborate on the liquidity reduction from 2020 to 2021? Are you planning to reduce further liquidity in the coming months?
Okay, thank you. So yes, of course, and as most companies took action during 2020, we increased the company's liquidity buffer significantly. And this was a precautionary measure due to COVID-19, and it was obviously the right decision to take. Of course, as the effects of the pandemic, start to fade away, especially in the second half of 2021, we started to normalize the company's liquidity cushion. Although right now it's still higher than what it has been our historical levels. And having said that, whilst we would gradually reduce liquidity given the present market volatility, we do not expect at this point any further material reductions in liquidity, at least in the short term.
Okay, thank you, Carmen. We have a third question on the outlook. Could you please summarize the outlook for 2022?
Okay, well, I think we have run through some of the key highlights during the presentation, but maybe just to give additional thoughts. At the outset, 2022 seemed to be a strong year of recovery, but of course the recent geopolitical events are marking the tone. I would still frame the comments that we did during the presentation. So as in terms of upstream, we expect Brent prices to remain around the $100 level per dollar per barrel, mainly driven by the geopolitical tensions. And we also expect production to gradually increase as OPEC quotas are uplifted. And in refining, we expect volatility to remain and the utilization rates, of course, to be adapted to market conditions. Within commercial, effectively what we expect is volumes to continue to gradually recover, again, absent of the extraordinary events from the geopolitical arena, although at a slower pace, and margins to remain stable. And in chemicals, we have a very positive outlook, with both volumes and margins expected at a minimum to remain stable.
Okay, thank you, Carmen. We've got another one on chemicals. How any potential delay in the chemical divestment division could affect the forthcoming release of the strategy plan?
Well, I would start by highlighting that obviously we don't comment on rumors that may be in the press in relation to the potential divestment of our chemical division. What I can reinforce, as we publicly stated at the end of last year, is that as part of our overall strategy to accelerate energy transition, we sort of transfer more autonomy to certain of our businesses, including chemicals. And of course, the energy transition requires responsiveness, fast management decisions, and speed in implementation. Our strategy, effectively, and this of course will be communicated on March 30th, it has no impact in the context of how our businesses sort of develop from the perspective of M&A. They are part of our, obviously core portfolio today. We're looking to deploy the best alternatives, as it relates to giving that greater autonomy. And of course, we will further develop, some of these thoughts during the strategy presentation in March 30th. So I look forward to having you join us then.
Okay, thank you. We have, I think, the last one on commodity prices. So can you please comment on how recent volatility in commodity prices, in particular gas and crude oil, is affecting your business, your financial ratios, and also your working capital and liquidity needs?
Thank you, Gonzalo. Well, I would refer to, to the earlier question where we address, what it is our short-term outlook. Of course, we will need to very closely monitor the events. We are just 2 months and a half into the year. And of course, what we're going to be is taking all the necessary measures to address any impacts that we may have, from the recent volatility. I think important to note, we have preserved in the past, showing the resilience, and we will do so in the future and adapt our financial ratios to make sure that we meet the criteria to, as I mentioned earlier, maintain an investment grade. So in that, you will see us, optimizing working capital, obviously managing our CapEx investment intensity, and of course, the operations of our businesses across all different segments.
Thank you, Carmen. There is another one, but I think we addressed it already. And could you please provide an update on the news related to the sale of petrochemical business? I think we addressed that in the earlier question. So
that's right.
Okay, it looks like there are no further questions. So thank you very much, everyone, for attending today's presentation. And as always, you will have all the materials related to the reporting package uploaded to the website as right now. And if you have any questions, you have the investor relations email address where you can, shoot us whatever questions you might have further down the road. Thank you very much for your time, and goodbye.
Thank you.